Welcome to Stony Finance Lab channel.
Now that you know a little more about personal finance, let's say you want to start investing your money in the stock market. How do you figure out what kind of investor are you, or how often or how much you should be investing? The process of figuring out all this is actually called investor profiling. In this video, we will be discussing the difference between investing and trading, the different ways of investing, as well as what is risk tolerance and risk capacity. Investing is the approach of sitting through market turbulences and riding through the up and downs for a long period of time. A long term investor values long term growth and can usually expect up to 7 to 12% in annual returns. A long term investor is also more likely to take advantage of interest, dividends, stock splits, as well as buying and holding assets. Based on your trading style, you can be categorized as a different type of trader. There's the passive, moderate, active, and automatic. The passive investor doesn't intend to beat the market and would rather invest in mutual funds, ETFs, and blue chip stocks. While the moderate trader wants long term growth, they would also have a balanced portfolio of stocks and bonds, either 50-50 or 60-40. The active trader intends to constantly monitor the market and their investments while actively researching and selecting stocks. Hands-off or automatic traders are those who don't have the time or interest in regularly researching stocks but wishes to invest. They would usually invest in stocks, mutual funds, ETFs, as well as a safety account, and they would do this through either a firm or a professional or an app. According to the Financial Industry Regulatory Authority, or FINRA, trading involves following the short-term price fluctuations of different stocks closely, then trying to buy low and sell high. There are long and short positions for stock purchases. A long position is when the investor fully owns a stock, while a short position is when the investor owes the stock to someone else but expects the price of the stock to fall so they can buy it back and pay back the lender. There are four different types of traders: position, swing, day, and scalp. The difference between each is the time period the trader holds the stock for. For a position trader, the positions are held for months to years, days to weeks for a swing trader, and for a day trader, it's throughout the day only. And for a scalp trader, it's usually only held for seconds to minutes at a time. Investors who purchase or sell options usually are speculating whether the stock will increase or decrease in price by a certain time period or the expiration date. For buying a call, the price of the stock is expected to increase within the expiration at the strike price of 100 shares. So, several scenarios can happen after a call is bought. One, if the price rises, the trader can sell the option at a profit. Two, if the price rises above the strike price it was bought at, the trader can exercise the call option. Exercising the call means buying the stock at the strike price. And three, if the price doesn't rise, you can sell the option at a loss and lose a part of the purchase price. And if the price does not rise, you can also let the option expire and take the loss, and you lose all of the purchase price. If you buy a put, you expect the price of the stock to decrease by the end of the expiration date. Like buying a call, there are also four possible scenarios as to what can happen. First is if the price drops, the investor can sell the put and take home profit. Two, if the price drops below the strike price it was bought at, you can exercise the put option or buy it at the strike price. And three, if the price does not drop, you can sell the option at a loss and lose part of the purchase price. And if the price does not drop, you can also let the option expire and take the loss and lose all of the purchasing price. So, what exactly dictates how much you're likely to invest in regularly? Risk capacity and risk tolerance are both factors that play a role in what kind of investor you might be. Risk tolerance is how much risk or volatility you are able to handle emotionally, and this usually differs with age, income, and financial goals. This can usually be determined through a questionnaire. Risk capacity, on the other hand, is how much you can afford to lose before it affects you financially or affects your goals, and this is usually affected by income. So, through this chart, you can figure out what kind of investor you are depending on your risk tolerance and risk capacity. For example, If I have a medium risk capacity and low risk tolerance, I am more of a conservative investor. So this chart can help you dictate what kind of investor you might be depending on how low, medium, or high your risk capacity or risk tolerance is. This is a two-question sample questionnaire from the advisor group used to determine one risk tolerance. This questionnaire is likely to include hypothetical situations regarding drops in the market, as well as how you're able to handle these drops. Like here in question 4 and 5, if the value of the stock market decreases, as well as how soon are you able to recover your funds after losing a significant amount of money. Recently, more and more investors are concerned with how ethical and sustainable a company is, and this is actually called ESG, or environmental, social, and governance, which are three elements investors might look for in a company before investing in its stocks. So, environmental. This includes what kind of contributions the company has made towards climate change, carbon emissions, and waste reduction. Environmental basically means how responsible is the company in protecting nature. And social, it is how the company manages relationships with its customers, community, employees, and suppliers. This also includes human rights, labor laws, health and safety, as well as its how well it's incorporated into the community it's at, and governance. So governance stands for how the company is run in terms of its company leadership, auditing, executive pay, and political contributions. This is basically how well balanced the company's corporate system is in regards to its stakeholders. And with all of this information, you can invest wisely and accordingly to your risk tolerance and risk capacity. And hopefully you now know the difference between investing and trading, as well as the four different kinds of trades there are, as well as options when it comes to buying or call or buying a put.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.